when you have seen the rupee decline nearly 1.5% for this week itself, the major cues really are coming in from the international markets, where you have seen the US dollar trading at around 1-month highs versus the Japanese yen and nearly 5-week highs versus the euro as well. Well, you have markets are expecting the US non-farm payroll data, and there is strength coming into the dollar ahead of that. Also, there have been statements from ECB yesterday where they said that the monetary stance to remain accommodative, and that is something that is putting pressure on euro and strength coming back into dollar because of that as well. In the domestic markets, even as the equity markets have been trading firm for a second straight day, the rupee really seems to be completely ignoring that one. Also, there have been reports of exporters holding back dollars on expectations of further decline in the rupee. That is something that's worrying the rupee as well. RBI also saying yesterday that they have no forex targets is something that has led to aggressive selling from the bears in case of the Indian rupee. The strength in crude prices at around 14-month highs also is a concern from worry. And it's not just India. You also have seen FIR outflows coming in from other major countries as well, and more than India, and these really are Korea and Taiwan, Thailand, Indonesia have seen more FIR outflows going in the recent few weeks quite strongly into the market, and that's something that's telling you that FIR outflows is not just in India, but it's a concern coming in for the Asian currencies as well, and that in turn also seems to be worrying the rupee. Going forward, well, the anonymous or synonymous view that's coming in for the rupee really is between 59 to 61 going forward as well.
Thanks very much, Manisha, for giving us a synopsis on the way the rupee is currently panning out. As promised, we've got our macro guest on board. Ajay Mahajan, managing partner at R Square Advisors, now joins in live. Ajay, thanks very much for being with us. What's making everyone nervous is the prospect that we're perhaps staring at levels of close to 65 against the US dollar. And while the RBI did its bit of promising to intervene when there will be volatility, do you think that it's done enough?
But I think, markets always have a tendency to forecast, in the direction in which there is a sharp move. And obviously at this time, most people are saying that there is more weakness to come. It's very hard to say whether we'll actually see 65 or will it top out around the 62, 63 mark. But one thing is quite clear, that at this moment of time, it is very hard to say that rupee has topped out already. And I think the reason for that is that, the world is coming to grips with this new sort of reality that the Fed has announced on the world, saying that they will be tapering for sure. Now, we can argue that the markets have perhaps in the short term overreacted to that. Large EM outflows have happened. There is basically rebalancing of portfolios worldwide that's happening. And until this portfolio exercise, rebalancing exercise continues, there will be definitely heightened volatility and perhaps more pressure on the rupee to come. But eventually, I personally believe that this is perhaps a larger overreaction than there should have been, and probably rupee should stabilize in the region of 57, 58. I don't think we run up to 54 or 55, and I also don't think that we run up to 65. Now, coming to the point of ammunition to the central bank, we are all aware that, the import cover now is somewhere between 6 to 7 months in terms of foreign exchange support, reserve support that Reserve Bank of India has. And no central bank, least so the Indian central bank, who's generally been fairly conservative and forward-sighted on these matters, would want to lose substantial amount of reserves in intervening at any specific position. So I think for now they are at 60, but if the markets were to move sharply and dollar strength were to gain sharply, and we could see, let's say, euro tumble all the way down to 123, 125, I don't think we'll see that. But I'm saying if the markets were to do that, maybe the RBI will actually sort of gently move away at 60 and probably come in back at 61 or 62. So I think they have to manage with limited amount of reserves intervention capability that they have, and I don't think the RBI would want to lose anything more than $20 to $30 billion of reserves from this position.
You saying that we will not rally up to or down to 65, Ajay, despite the fact that dollar has been strengthening against almost every other emerging economy, and the fact that, the concerns over the food security bill as well. That impact is priced in, you think?
Well, I think, we have to also look at the positives as well, Neeraj. In the last few days and weeks, there have been some steps that have been taken, and we can argue that these are not necessarily, massive reforms. These are sort of items that were sitting on the pending list of the government for a very long time. But we must recognize that, we are in a year which is, in a run-up to elections. It is not possible to probably see absolutely, very difficult kind of reforms to be pushed through. So coming back, I think on the food side, what has been done very recently will definitely, add more to the fiscal deficit. I have not seen the numbers, but probably this will add probably 20-25 basis points to the fiscal deficit. So from that point of view, it is not good news. But we must also recognize that ever since Mr. Chidambaram took over as the finance minister, there has been fairly controlled spending by the government, and the fiscal deficit numbers have, at least incremental spending thereafter, has fairly been controlled well. So, barring this populist move and probably one or two more that might come since we are in an election year, I think overall the control on the expenditure side has been reasonably good. The big issue will come from the currency side, and there is two large impact that this currency weakness will actually deliver. One is the imported inflation. So inflation numbers can certainly see a reasonable uptick. But the good news there is that inflation has tapered off quite sharply, and we're all seeing WPI come down. Core inflation is 3% levels. So, there is room perhaps to accommodate a little bit of push through imported inflation. The other thing, obviously, that the weakness in rupee will cause is the fiscal deficit pressures will increase because the government has to spend more money on oil. And I guess the related worry is that oil prices have actually not come off. With what's gone on in Egypt, with army taking control and the president is ousted finally in Egypt, some of the Middle Eastern tensions and geopolitical risks that are factored into the oil prices will probably come down. So one hopes, honestly, that we will see probably 5 to 10% gradual reduction in global oil prices. That should also augur reasonably well for the rupee going forward. I think in sum, what I would want to say is that a lot of India's domestic and current account deficit related pricing in of the weakness in the rupee has already been done. Now what we will probably do or see is a rupee move will mostly be in tandem with the way emerging market currencies are dealt with globally. So I don't see, rupee sort of underperforming other EM currencies is what I'm saying in a nutshell.
Yeah, which is a fair point, but I think the only concern over that would be that the other emerging market currencies may still continue to depreciate. Ajay, just one word really, which may probably have an impact or touch upon the rupee as well as the bond markets too. The belief is that over the next couple of years, US bond yields would continue to rise, rates would eventually go up, and therefore there will be a continuous flow of capital outwards if indeed the domestic macros don't improve meaningfully. If that were to happen, the impact on the bond markets as well as the currency, to your mind? Well, if you ask this question from a short-term point of view, we have already, I think, addressed that, and you've also, in your question itself, recognized that there is pressure in the EM in the EM world at this moment of time due to outflows. But I think, taking a slightly longer horizon, as you probably suggested, of let's say 2 to 3 years from here, my comments are that it's firstly very, very hard, and I have to be honest, to actually forecast 2 or 3 years from here. But I would still attempt it since you asked the question. I think the way the 10-year yields have actually shot up from levels of about, let's say, stable levels of 1.75 to levels of 2.5, 2.55, 2.6, wherever we are, we're almost 100 points up from the bottom. And Fed has gone on record several times, virtually in every FOMC, suggesting that the short-term cash rates or what we call LIBOR, 1 month, 3 month, 6 month LIBOR rates are not going anywhere up from where we are today. So we are likely to see short-term rates stay near the 0.5% mark for at least the next 2 years. How much more can the yield curve steepen from here is the question we are trying to answer. And the yield curve has already steepened out, like I said, 0.5% 6 month LIBOR. We're talking of 10-year swap rates at 275 now. So there is a fair bit of tightening that has already been priced in to the US yield curve. So honestly, I think from a short-term point of view, we will probably see US rates decline. The 10-year swaps and even the 10-year treasuries will probably appreciate. That is, treasuries appreciating, yields declining by about 40 to 50 basis points from here. Because let's face it, US economy has its own problems. I mean, it is performing better
than the European economies, but it has its own problems. We see the ISM data that came out, not great. 54 or 54.5 expectation, we came in at 52. So US data is also mixed. We have to obviously watch the payroll report of today, and we also have to look at the unemployment numbers going forward, and how much real radical secular improvement is US economy making is not something that we can just absolutely assume. So my point is the markets are probably ripe for a pullback. We will see risk appetite coming back in moderation. Nobody is saying that we'll see a massive bull market, but I think the risk appetite will probably come back in the next few months, and I think the market's overreaction to US rates hardening in the immediate term will probably be tested going forward.
Ajay, always a pleasure having you with us on the show. Thanks very much for taking the time out and joining in with your expert opinion.